Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell this week. So let's first get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canada is considering joining the Joint Expeditionary Force, a UK-led multinational rapid response military group, as it looks to deepen security partnerships. Defense Minister David McGuinty says the country is assessing potential memberships, but is currently focused on rebuilding the Canadian Armed Forces. Now, the review comes as Prime Minister Mark Carney meets with Keir Starmer in London, with Defence Corporation and Arctic security among the topics on the agenda. BCE, CoreWeave, and Cerebras Systems will collaborate on one of Canada's most powerful data centers in Saskatchewan. The 300-megawatt facility will be dedicated to AI computing, and the first phase is expected to come online in the first half of next year. BCE plans to invest $1.7 billion to build the facility's 4 data center halls and says the project has the potential to generate economic value of about $12 billion. BCE is the parent company of BNN Bloomberg through its Bell Media division. Shares of Meta Platforms are up in the pre-market today. The tech company has signed a major AI infrastructure agreement worth up to $27 billion US with cloud provider Nebius Group. Now, under that deal, Nebius will provide $12 billion in dedicated computing capacity starting in 2027, with Meta committing to purchase as much as $15 billion more as additional infrastructure is built. There's also reports the social media giant is planning layoffs, which could affect 20% or more of the company. And we'll take a look at the markets, the pre-markets this morning. U.S. futures all trading up at the moment, particularly the NASDAQ up by more than a full percentage point before the opening bell today. If we look at the TSX, ended on a down note on Friday, that's for sure. It was down for quite a bit on Friday over the last couple of days. We'll wait to see whether it can rebound today amid all the turmoil that we're seeing really around the world. And if we take a look, speaking of that turmoil, at the price of oil, it was trading in the triple digits earlier this morning, now at 95, as the war in the Middle East continues to affect output of oil and shipping, obviously affecting the price of oil. We'll continue to talk about that today. And then just a quick check on gold as well, wavering amidst high oil prices as well. And we're also watching for those rate decisions. That's happening this Wednesday, both in Canada and the U.S. That could also affect the price of gold, currently up just over $5,000. Well, all eyes in tech will be on Jensen Huang today as NVIDIA kicks off its GTC conference. It's expected that a brand new chip will be unveiled. So here to tell us more is Dan Rohinton, Portfolio Manager at IA Global Asset Management. It's good to have you join us. Thanks so much.
Thank you.
Okay, so Dan, let's talk about this new chip that's expected to be announced today. What are you expecting around this announcement and around this new chip?
Yeah, so there's 2 elements to it, right, Lindsay? There's the Cerberus chip, the Grok chip, which was the ultra fast for really specific use cases platform that they're expected to talk about. Then it's also the next generation after Blackwell, which is Feynman, and that's something that's going to be rolled out in mid to late 2028. We actually saw adjacent with the NVIDIA news and expectations that Meta is partnering with Nebius, and that half of that Nebius allocation is the new generation Feynman chip. So NVIDIA is already racking up orders for a product they haven't fully even announced yet. So it should be clearly bullish. The question is just how bullish it is for investors versus their already high expectations.
You say this is the first time NVIDIA is putting another company's processor directly into its own server racks. Can you talk about how significant that is?
It's actually, so one of the biggest criticisms of NVIDIA, despite everything Jensen's done well, is the belief that they don't have the same monopoly in inference, which is us actually talking to ChatGPT or Claude or what have you, versus training those models. So NVIDIA dominates training, but it's a little bit more nebulous whether they dominate the inference side. And this type of chip is something that is very inference focused and very fast at it, especially things like coding use cases. So that's why what you see here is really an opportunity for NVIDIA to prove through their Grok platform that they are the winners on not just training, but also on where the future is going, which is inference. So I think they'll do a good job at it, but that is the real tale of the tape on this afternoon.
Do you expect to see the stock price go up after this, or what are you expecting to see this week after this announcement's rolled out by NVIDIA? Maybe a little bit of good news for the company?
I think it's the stock's pretty dirt cheap at this point. And when we're talking about all of the positive data points that we hear about memory or the big cloud computing companies spending all this capital, all of roads effectively lead through NVIDIA. So I know the stock's been up almost 60% on the last year, but the stock valuation is actually some of the cheapest it's been in a decade. So I think NVIDIA is a buying opportunity today, and I think this event is the start of a catalyst path for us to start seeing the stock cross into the 200 plus range. So we're pretty optimistic, and we're buyers today.
Okay, so let's move on. We're going to talk about the volatility in the market, but obviously that's influenced by a lot of geopolitical factors that are happening right now. Of course, I know you know that. I want to hone in, though, on that meeting between U.S. President Donald Trump and Chinese President Xi Jinping. That was supposed to happen at the end of the month. Donald Trump saying he's now maybe going to delay that meeting if China doesn't step into what's happening in the Middle East and try to interfere in some way. What do you think about what's going on there? Do you think that Donald Trump will actually delay this meeting? It's supposed to be March 31st.
I think there's a lot of back and forth negotiations that go on in these types of high stakes things. Remember, I've always said when we've had conversations, all roads lead to U.S. and China. Every country, where we talk about it, it's the Cold War that we need to talk, that is driving every single decision. So the fact that China is looped in, if you will, to the Iran situation, I think is just inevitable, because China buys almost 40% of the oil that comes out of that strait, and the vast majority of Iran's oil goes to China. So this is basically Trump saying to China, it's not that there's going to be a military escort coming through with Chinese characteristics. It is effectively Trump telling China to tell Iran to stop shooting at U.S. boats. That's effectively the way I see it. So if China says yes, then the summit's probably on. If China says no, thank you, which they're likely to do, then it's probably going to get more complicated from here.
And if you say, if China does say no, thank you, then this could maybe be, delaying this meeting could actually be a win for China.
Potential win for China depends what China is giving up, right? So one thing I would say is at a high level, and this is a slight tangent on our conversation, every day oil prices are $100 or greater is bad news bears for China. Because when you think about the biggest oil importer on a dollar basis, that is China itself. So China does not want oil crude prices up 40% on the year. They would much rather have $30 crude than $100 crude. So it is in China's best interest that crude flows freely, consistently, and at low prices, because they are the consumers of energy, along with India, Pakistan, and basically the whole Pacific Rim countries. So I would say they could win from a rhetorical standpoint by delaying the summit, but from an economic standpoint, this is doing disproportionate harm to the Chinese economy.
And when we take a look at the markets, obviously probably expected to see more volatility, particularly when it comes to the price of oil this week, Dan, as we enter, I think it's the third week of this war in the Middle East. What do you expect to see there? Like, are there any developments in the near future? Obviously, the Strait of Hormuz is apparently shut, more so controlled than it is actually shut, but not a lot of oil getting down that avenue at the moment.
Yeah, I would say, I think the one thing I would broadly say is there's a belief that the U.S. is losing this war. I would take the opposite side of that. I would say it's very obvious that the U.S. is winning, and it's just a question of timeline. So conflicts, even short conflicts have lasted weeks, if not months. So saying that it's been a few weeks and things aren't going exactly and perfectly to plan, I think misses the point that Iran doesn't have ballistic missile launches coming through. The suicide drone attacks have come down significantly, and their command and control is in complete disarray. So I would say by all military metrics, China, the U.S. is winning without any question. Where the economic impact happens from here is if the Strait of Hormuz operates as is, I don't think it's sustainable. Where Iranian and Chinese crude gets through, but U.S. and allied crude does not get through, I don't think that paradigm is sustainable. So either we see a full closure, which I don't think anyone wants, including Iran, because that's where they earn basically their only source of income, or a complete reopening. I think we're at that binary, if that makes sense.
Interesting stuff. Okay, we'll leave it there. Dan Rohinton, Portfolio Manager at IA Global Asset Management. Always good to get your opinion. Thanks so much. After the break, BCE, CoreWeave, and Cerebras Systems will collaborate to build Canada's most powerful data centers in Saskatchewan. We've got more on that coming up right after this. Stay with us. And we are joined now by the CEO of BCE, Mirko Bibic, to talk about the company's latest AI initiatives, including a major new investment in Saskatchewan and what investors can expect going forward. So, Mirko, thanks for being here. Thanks for joining us this morning.
Thank you for having me, Lindsay. How are you?
I'm good, thank you. So this is a really big announcement today for Bell. This would be, if we're talking about this AI data center that's being built in Saskatchewan, the largest purpose-built AI data center anywhere in Canada. Why Saskatchewan?
Well, we've had tremendous discussions with the Saskatchewan government. It's essentially a partnership where we've come together. Saskatchewan wants to be at the epicenter of AI industrialization in Canada, and so when we start talking about the Bell AI Fabric vision that we have, we just had a meeting of the minds where Saskatchewan's coming forward with 300 megawatts of power allocation, and the Crown corporations, whether or not it's SaskTel that's going to bring fiber to the site and interconnect that fiber to our national fiber backbone, and then SaskPower. We've had really interesting discussions, led to an MOU, and here we are. We're going to have the largest purpose-built AI data center in the country, right here in Regina. That's where I am talking to you right now. We're going to have a media event and an announcement with the Premier later today. They really want to, grow the economy, modernize their economy, and get some GDP going.
Can you break down the price tag a little more? Like, how much is this going to cost, and how much funding, if any, is the Saskatchewan government investing into this new data center?
Yeah, so there's no public money allocated to this. So the Saskatchewan government is not directing any public funds to this deployment. Bell's going to invest $1.7 billion in order to build the purpose-built data center. Think about it as 4 data halls that are going to be brought online by the end of next year, with 2 major global AI leaders as our core tenants for this facility. And those tenants, CoreWeave and Cerebras, will be bringing in the compute hardware to run the AI workloads in the data center. So if you take the 1.7 billion of direct Bell investment and you consider the compute hardware that the 2 tenants are going to be bringing in, we're talking about well over we're talking essentially close to $12 billion of direct investment right here in the province.
What will these centers be supporting, right? Because when you hear AI data centers, it can be supporting a number of different things. This center in particular, what's it going to be supporting?
So this data center is fully allocated. So the 300 megawatts have already been allocated to the 2 customers, Cerebras and CoreWeave, and they'll be using the capacity in order to meet the demands of their own customers, their own off-takers. At the same time, though, we made sure to have the ability. We've reserved a significant amount of the compute capacity to meet sovereign AI demand in Canada for Bell clients.
Obviously, some concerns for local residents when they hear a data center is going into their communities, electricity costs, and those electricity costs rising. So where will the electricity really come from for this data center, and will residents within Regina, I guess, be paying the price?
Well, we're very mindful of kind of the community around us. So first of all, this is going to create a lot of economic activity in Regina and the surrounding area. So that's phenomenal, and we're going to make sure that first and foremost we take care of local procurement. We really want to do that. We'll be plugging into the industrial energy grid here. So not the residential grid, the industrial grid. That's important. And there have been some questions as well around water. And this data center will not draw at all on local water sources. It uses basically technical water. So bit of a quasi-technical term there, but it's not tapping into local water sources at all. And we've got a closed loop cooling system. And those, and as well, there's waste heat that's generated by these AI data centers, and we're looking at developing a district energy grid that we can direct the waste heat to create alternative energy sources.
I was going to ask about water and waste heat, so we got that knocked off now. But just when you were talking about being plugged into the industrial electrical system, does that mean local businesses would be paying the price?
No, not at all. This is power allocation that SaskPower has available for uses like this, and this is going to create tons of economic activity, direct and indirect. So Regina is going to be one of the epicenters of AI industrialization in Canada, which is fantastic news.
Okay, let's talk about jobs now, because Bell's saying construction alone expected to support at least 800 positions, 80 full-time roles once operational. So when it comes to permanent jobs moving forward, that's the 80 jobs?
Yeah, across Bell and Cerebras and CoreWeave, we're looking at least 80 permanent jobs in the facility to run the facility. And of course, this is a big development. $1.7 billion in direct investment by BC alone over 2026 and 2027. So there's going to be a significant number of construction jobs that are going to be brought in.
You also say, based on industry research, as much as 750 additional community jobs could result from a large data center. I'm just reading off the press release here. What does that mean? Like, what kind of jobs are you talking about there?
Well, when you have the ability to plug into to these AI data centers and direct AI workloads in facilities like this, there's a number of knock-on economic benefits that come from this kind of economic activity in a region, and that's what we're talking about. Standard economic studies show that if you build AI data centers like this, the orders of magnitude of economic benefits continue to spin for years to come. So that's what that's referring to.
Okay, so let's talk a little bit more about Bell as a whole, just before we wrap up here. Obviously, for investors who are listening, since the start of 2026, it seems as though the stock price has been going up. What has your company been doing really to have that kind of increase in that growth that we've seen so far this year?
Yeah, so we started last year when we strengthened the balance sheet, optimized the cost of capital, and then at Investor Day in October last year, we outlined a clear strategic plan based on 4 key growth areas, all tightly linked together and all based on our core underlying strengths. And it's just a question of executing against a very forward-looking, clear strategy. Has ambition. We've built a lot of momentum. One of our key strategic priorities is to lead an enterprise with AI-powered solutions, and that growth vector has significant amount of momentum. This is one of the key planks of that growth vector, and we're going to continue to execute. So we had our financial targets set out for the next 3 years that we laid out in October of last year, and we're already upping those targets given this announcement today.
Okay, and just before we wrap up here, for investors, any headwinds that the company is facing in the year ahead? Like, what challenges are you kind of watching out for that you think investors should also be keeping their eyes peeled for?
Right. So we considered headwinds over the next 3 years when we laid out our Investor Day targets back in October, and so that was that was factored in terms of the things we would have expected to see. So today's announcement is around how the AI data center announcement in Saskatchewan allows us to increase those growth targets, and we indicated today on an analyst call that we are not changing any of the guidance targets for the underlying business otherwise.
Okay, we'll leave it there. That is Mirko Bibic, CEO of BCE. Thanks so much for joining us this morning. Appreciate your time.
Thank you, Lindsay.
When we come back, Iran strikes the Gulf oil hub as it rejects Donald Trump's ceasefire claim. We've got more on that right after the break. Stay with us. Welcome back. Iran continues to send rockets and drones against its neighbors, attacking U.S. bases and interests as the U.S. and Israel retaliate. So for more, we're joined by CTV's Scott Hurst with the latest as we enter, I think this is the 3rd week, Scott. So what is the latest assessment this morning in terms of what's happening with this conflict?
Lindsay, good morning. It really remains quite a volatile conflict as tensions in the Middle East remain high. As you mentioned, the war in Iran now entering its 3rd week, and really the ripple effect continues to be felt far and wide. Many of your viewers, investors, likely feeling the impact, along with consumers here in Canada, with the disruption to oil shipments and key trading routes, sending shockwaves through the global economy, with prices and markets continuing to fluctuate wildly as the U.S. president is now ramping up efforts to secure the vitally important Strait of Hormuz, calling on allies and China to do more to help reopen the strait, demanding other nations send warships to protect the vital shipping channel. Canada's stance remains the same. It says it is not getting directly involved in the conflict. We heard that from High Commissioner to the UK, Bill Blair, former Liberal cabinet minister, speaking ahead of the Prime Minister Carney and Prime Minister Keir Starmer meeting in London, with the UK saying it's working with European allies, but the UK is unlikely to deploy warships in response to Trump's call. We're also hearing from more European allies, Lindsay. Italy offering a reluctant call to join Donald Trump's message of other nations sending warships to help secure the Strait of Hormuz, and Germany as well, stating this is not NATO's war and would not take part in any operation through the Strait of Hormuz, as this has virtually been shut down for shipping because of the threats from the Iranian regime on this vitally important waterway, Lindsay.
It's going to be interesting to see just how long so many of these countries can stay on the sidelines as prices for people start to go up. And a diplomatic solution seems further away than ever, right? How long can this war actually continue?
In the immediacy, it's hard to see an immediate off-ramp. It's hard to see any path towards this, diplomacy. As we mentioned, this is now in its third week of the U.S. and Israel targeting the Iranian regime, with Tehran launching many counterattacks against several nations in the Middle East. And so all that continues, as the U.S. president has previously said Iran wants to negotiate, but the Iranian foreign minister has disputed that claim. So we're really seeing and being offered differing timelines, and really not a whole lot of clarity, Lindsay, from the Trump administration on the overall mission. So what we are hearing, despite the conflicting reports, the U.S. and Israel suggesting the fighting at the very least could go on for several weeks. So seeing this diplomatic off-ramp, seeing the path towards diplomacy, might be hard to think of in the days and weeks ahead, Lindsay.
Okay, that is CTV News' Scott Hurst reporting live for us this morning with the latest on the situation in the Middle East. Scott, thanks so much for that. And opening bells are next. Stay with us. We'll be right back. Welcome back. Here are the opening bells at the NASDAQ this morning. Acadia Pharmaceuticals is ringing the opening bell. Ireland Day rings the opening bell, and TSX Loblaw is celebrating the company's 70th anniversary of being listed on the TSX. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity markets this morning. We'll begin with the TSX. It saw a couple of down days to end the week last week. Right now, though, trading up by 0.4%. Same with the U.S. markets. Investors seemingly a little optimistic this morning. The S&P 500 up 0.8%. The NASDAQ up almost a full percentage point to start this Monday morning. We'll see how this goes throughout the week and throughout today, but so far off to a relatively more optimistic start. We'll take a look at some Canadian stocks to watch this week, and particularly this morning, especially when we see how they finished on Friday, because Empire Co. is one company we're watching closely. It finished top of the TSX on Friday after reporting relatively strong third quarter results and an adjusted EPS that matches estimates. You can see currently up by 0.1% to start the day. First Majestic Silver, another company that we're watching, finished much lower on Friday and moved even lower in pre-market trading today after some losses in its fourth quarter. Obviously, precious metals are being hit a little hard right now in terms of everything that's happening geopolitically. And speaking of geopolitical tensions, we're watching the price of oil today, and therefore we're watching some major energy companies in Canada, including Canadian Natural Resources, currently down by 0.5%. Obviously, this company, along with many others on the TSX, pretty sensitive to crude oil spikes, which is what we were seeing today. Obviously, oil up in the triple digits earlier this morning, still up pretty high at the moment. Suncor Energy is another company that we're watching, which is down by 0.6% at the moment. Again, pretty sensitive to what's happening in the Middle East, what's happening in Iran in the Strait of Hormuz. And so we'll continue to watch those throughout the day. And for movers south of the border now, we are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team Stocks. Jeff, it's good to have you this morning. So we'll start with Meta, rising after reports of some widespread layoffs. Tell us what's happening there.
Yeah, that's right. This is quite a number of layoffs. This is also one of the top performing stocks in the S&P 500. It's currently up about 2.2%. It was up more sharply than that in the pre-market session. So it is definitely worth watching over the course of the day. What happened here? Reuters reported on Friday that Meta is apparently moving ahead with laying off potentially 20% of its workforce. This is a company that employs 70-some thousand people. So 20%, I don't have the exact number that they currently employ, but it would be about 15,000 people that are being laid off. Now, Wall Street this morning is out with a handful of notes saying that this would do two things. One, this would likely kind of boost the confidence that AI and their investments in AI might be worth the amount that they're paying for them, because you may see some efficiency gains here. The other thing that analysts are saying is that while layoffs had been rumored at Meta, this is a pretty high number by comparison with what Wall Street had expected. 20% is higher, according to KeyBank, than analysts had been expecting, and therefore perhaps showing maybe a little bit more depth to the cuts, and perhaps more efficiencies from AI, which is in focus because this company is spending a ton of money on AI. So if those efficiencies are showing up, that will also help kind of soothe investor worries about this company.
Yeah, no kidding. But something people have obviously been worried about with AI, of course, is losing jobs. So that's a pretty significant number to be cutting. You're also watching Micron, which is gaming this morning. What's going on with Micron?
Yeah, Micron is a simple case where Wall Street is very excited about the results that are coming up here. So the company got two price target boosts this morning, one from TD Cowen, one from RBC Capital, but kind of across Wall Street and Bay Street, there's a lot of optimism about this stock as they're heading into their earnings. This is a chip maker. This is a stock that has been doing very well over the course of the year. They're up nearly 50%. And they're lifting their own peers today. So, a handful of other companies in that same space are up. Worth watching over the course of the day. This is it was the top performing stock in the S&P 500 in the pre-market session. It's up pretty sharply. RBC raising the price target to 525 from 425. So that's a great big lift. And TD Cowen raising it to 500 from 450. So definitely keep an eye on Micron. Wall Street likes what it sees so far, and we haven't even seen the results yet. So worth watching.
Worth watching for sure. Okay, Jeff Morgan of Bloomberg, appreciate you joining us this morning. Thanks so much.
Thank you.
Coming up, inflation slowed more than expected last month. We'll get more on that right after the break. Stay with us. Headline inflation fell to 1.8% last month, which was lower than what analysts were expecting. And here to tell us more is Jimmy Jean, chief economist and strategist at Desjardins. It's good to have you join us to break all this down. So lower than what economists were expecting. Is this maybe like a glimmer of good news for Canada, do you think?
In a sense, it's a little bit bittersweet in the sense that you do see that improvement in inflation and underlying inflation in very particular. But at the same time, you know what's coming ahead, right? We had those events in the Middle East that are boosting gasoline prices. So those are going to be reflected in upcoming numbers. Now, of course, normally the Bank of Canada should be in the business of looking through those particular forces. But still, what happened post-Ukraine is still fresh in everybody's minds. So, that report per se in a good direction, but still being alert to what's coming ahead.
Yeah, I take your point on that. We'll talk about what's coming ahead in a moment, but just to break these numbers down a little bit more in terms of sectors, what sectors saw the most inflation last month?
Yeah, so we see, for example, big gyrations. For example, in terms of month-to-month influences, you see big gyrations in travel tours. This is not unusual. It's up 22% on a monthly basis, but on a year-over-year basis, it's still down 3%. So it shows you how volatile typically this category is. So that's nothing to really worry about. I think where we saw some great improvement was in food categories. Part of it was expected. It's due to base year effects, the GST break of last year ending, and so when you're making those comparisons, they look better. I think March is going to look even better on that front, but mostly mechanical reasons. But I think most interesting was the what you saw in meat. So grocery prices in particular showing a significant decline there. So some good relief for consumers at the grocery stores. But I think most importantly, when we think about where inflation is, the big picture is that we're right at the target, and even you look at underlying measures, they're below the target. When you look at 3-month annualized, in particular for the core measures, shelter in particular, we often said that shelter was the very last battle for the Bank of Canada. You're looking at shelter, and it's pretty much back at pre-pandemic levels, even at the lows of during, right after the pandemic hit. Rent just crossed below 4% for the first time since 2022. So that's the impact of policies, especially as it relates to immigration and to alleviate those pressures. And it shows that those policies have been working.
You mentioned this, the sales tax break from last year impacting those February numbers, and you say probably March as well. Can you just explain to our viewers exactly like how that works, how it's impacting what we saw and what we could see moving forward?
Yeah, so just to recall that the Liberal government under Trudeau in November 2024 had introduced measures, a tax break, GST break, that targeted mainly food categories, and particularly food at restaurants. So that lasted 3 months. So it was from mid-November to mid-February. So the fact that it ended in the middle of February 2025, it means that part of the month had those discounts, and the other part of the month had the actual GST increase. So you're comparing a month with that partly has a discount to a month, February 2026, that has no discount. So that's why you've been having those effects, those pressures when you looked at the year-over-year numbers in the last few months. But now you're coming back to something that's more normal. And in March, you're going to be it's going to be the first month when you're going to be comparing apples to apples, and no discount in either case. So that's why you're seeing that year-over-year number coming down.
Interesting. Okay, so now let's look ahead, because as you mentioned, there's a lot to look forward to in the next couple of months in terms of how this could affect our economy. Obviously, the conflict in the Middle East could really affect things and could affect inflation moving forward. But can you explain how? Because I think obviously people see higher oil prices. We know the price of gas is going to go up. But how else could this conflict in the Middle East affect other sectors moving forward?
Yeah, and that's very important. As you mentioned, the obvious part is already visible. But really, the second round effects is something we should be alert to. And if we recall, in the Ukraine episode, we saw a big run up in food prices, and part of that was due to gas prices globally shooting higher, and that just boosted the prices of fertilizers and of food commodities in the pipeline. So it does suggest that we're at risk of seeing something similar. We've seen gas prices skyrocket in Europe in particular. So thinking about inflation going forward in the next 6-12 months, are we going to see the same type of pressures hitting again the food categories, where we're just starting to see some tentative signs of improvement? That's something to keep in mind as well. Of course, when you think about anything that's related to transportation, either business transportation or air travel, things of that category, or just the shipping industry, and you're seeing all those insurance contracts going higher. So shipping is going to be more expensive, and that could be also transmitted through end consumer prices. So there's a lot in terms of inflationary consequences with what's going on, but at the same time, it's hitting purchasing powers in a very significant way. And the economy is very fragile in Canada. We saw that in the latest job numbers. So it makes it very tricky for the Bank of Canada to take a firm stance. It's going to want to wait for more data to see what factor dominates.
You think so? Okay, so you don't expect anything different this Wednesday as the Bank of Canada's rate decision. You factor in the CPI numbers we have today with employment numbers we saw last week. You still think it's going to take a while before we see any different decisions, I guess, coming from the governor?
I do think so, because you have a number of conflicting forces at play right now in Canada. The higher oil prices, normally that's a positive for Canada, given that we're a net exporter of oil. But at the same time, in some provinces, it hits on consumers' pocketbooks. You also have developments in housing that are in Vancouver and Toronto that are very, very negative right now. And as we just saw, the job market is slow, and surprisingly so, but it's slowing very significantly. And that's very important in terms of when you think about the macro picture. And, if we were to see more numbers like we saw on Friday, quickly, you would start to see the R word being pronounced more often. So that's where the Bank of Canada, I think, is in a difficult position of trying to figure these developments out, and not to forget what's coming ahead when it comes to the CUSMA revision process, which is anything but certain.
For sure. Okay. Jimmy Jean, Chief Economist and Strategist at Desjardins. Always good to get your opinion. Thanks so much for joining us.
Pleasure. Thank you.
Well, Friday on Market Call, we were joined by Tony Ciro. He's Vice President and Senior Portfolio Manager at Caldwell Securities, and he was covering North American large caps. These were his top picks: Microsoft, ServiceNow, and Tourmaline Oil. Today on the show, we have Teal Lind. He's founder and chief investment officer at Lind Equity Fund, and he'll be taking your questions on North American stocks. So be sure to stay tuned for that. Just ahead, Canada's two top leaders are out of the country today, with Prime Minister in Europe and the leader of the opposition south of the border. We'll find out why next. Canada's two top leaders are out of the country, with Prime Minister Mark Carney in London and opposition leader Pierre Poilievre in Texas. So for more, we're joined by CTV's Rachel Ayala. Rachel, it's good to see you. So we'll start with the Prime Minister, Mark Carney, in London today. Who's he meeting with?
Yeah, good morning. Nice to see you as well. So Prime Minister Mark Carney started his day meeting with UK Prime Minister Keir Starmer at 10 Downing Street. That happened a bit earlier this morning. Now, according to readouts from both men's offices, they spoke about a few key issues. One, of course, being the situation in the Middle East, both leaders reaffirming their support for the need to protect international shipping through the Strait of Hormuz. And then, of course, they also spoke about Russia's ongoing war in Ukraine, both countries reaffirming their support for Ukraine and their ongoing efforts there. And then really there was a lot of emphasis on the strengthening relationship between Canada and the UK. This is Mark Carney's third time visiting the UK as Prime Minister, obviously familiar stomping grounds for Carney given his time as the Bank of England Governor. And in addition to this official visit with Keir Starmer, later today around noon Eastern, we're expecting the Prime Minister to meet with the King. Now, this is going to be happening behind closed doors and without any Canadian pool media, because the Keir Starmer visit was actually the end of his official itinerary of his latest international trip. Not only is the meeting with the King behind closed doors without any access to media, so is the rest of the Prime Minister's week. He's spending the rest of the week in Europe on what his office is calling personal commitments.
Interesting. Okay. Meanwhile, opposition leader Pierre Poilievre is in Texas today. Obviously, he's a little lower in the polls, trailing behind Carney, trying to pick up some of that momentum he hasn't seen in a while. What's his game plan? Why is he even in the U.S.?
Yeah, so this is part of Poilievre's effort to demonstrate his ability to be part of Team Canada, show his statesman-like capabilities. Obviously, with the Prime Minister traveling here, there, and everywhere, Poilievre has indicated that he wants to get out and meet other leaders as well. So today, we're going to be seeing him in Houston, Texas. There, he's going to be meeting with energy leaders as well as touring an energy facility. And then tomorrow, he's going to be in Austin, Texas, meeting with state officials and business leaders. And this leg of his U.S. trip is really focused on trying to sell Canadian energy, Canadian natural resources to the U.S. market, tied in, of course, to the ongoing trade conversation, but in a way that he's trying to pitch Team Canada without getting in the middle of the actual cut and thrust of the trade negotiations. So that is really the motivation for Poilievre's visit. We've heard earlier in the week him speaking about this new auto pack strategy. Now he's going to go talk energy and natural resources. All of this will culminate with a keynote speech in New York later this week.
Okay, we'll be watching for that. That is CTV News' Rachel Aiello joining us live. Rachel, thanks for that.
Thank you.
Coming up, the crisis in the Middle East continues to push gas prices higher here in Canada, and it's giving electric vehicle advocates fresh ammunition as they argue cutting our reliance on oil could help shield consumers from global shocks. We've got more on that coming up right after the break. The crisis in the Middle East continues to push the price of gas up in Canada, and it's also prompting EV advocates to talk up the benefits of diminishing our reliance on oil. CTV's Quebec Bureau Chief Geneviève Bogeman has more in this report.
Those in EVs bypassing the gas station avoid this sticker shock. A litre is now hovering around $1.88 in Montreal.
I've been aware of the price of gas. I haven't been watching it. Because I don't have to.
And how does that feel right now?
Pretty good.
The electrification industry says the latest oil crisis serves as a reminder that volatility is part of the gas game. Not so for cheaper power. And Electric Mobility Canada says those looking to buy Canadian should consider what they put in the tank.
More than 70% of the oil sands are owned by foreign companies. And the vast majority of electricity production is owned by Canadian utilities.
But that may not seal the deal for many car buyers. After all, critics say the high price of oil is cascading throughout the economy, where EVs are still a pricey bet.
Even if you drive an electric vehicle, it's going to impact the cost of pretty much everything, including the building of those EVs.
That has some pushing other solutions that have nothing to do with EVs, including government-issued rebates to make up for higher gas prices. This as the latest Statistics Canada numbers show new zero-emission vehicle sales slowed 36% from December 2024 to December 2025. EV advocates, though, say they see early signs of a reversal in that trend.
The future of the auto industry.
A February announcement of a return to federal EV rebates could be giving the industry a boost, say advocates. To Gilbert Bouc, no pain at the pump is an added benefit.
At one point, I was not sure, is it really worth it or not? But the price of the gas now, I guess it's worth it.
Now, it's not clear just how long this volatility will last and whether indeed it will be part of the decision-making when it comes to EV purchasing. Geneviève Bogeman, CTV News, Montreal.
Well, from EVs to AI, it's no secret that artificial intelligence is in some ways making lives easier. If you're working on your resume to apply for a new job, AI can help produce a finished product sure to impress. But as CTV's BC Bureau Chief Andrew Johnson reports, the number of job hunters that are cutting corners with AI is creating new headaches for hiring managers trying to figure out who they really are dealing with.
Eden Potier spent his teens breakdancing his way into high-level competitions. But dance doesn't always pay the bills, so he's at this employment center looking for a job in the trades.
A little bit daunting, to be fair. You go on Indeed, and there's so many different jobs you can apply for, and when you look at how many people have applied to each, it can be kind of overwhelming.
Potier knows new tech can help, but he's not sure about artificial intelligence.
I think it kind of becomes unfair for the person who tries to not use AI and wants to actually put the effort in themselves.
Many others have gone all in on a world where sweating over resumes and fighting with formatting is a thing of the past.
A lot of our clients have learning disabilities. I myself have dyslexia, so I have that unique perspective of knowing just how much it sucks.
Now AI can take care of that and your application will look great. But then what?
You can't trust the documentation you're receiving from candidates the same way anymore.
Recruitment agencies say resumes are all starting to look the same, and your perfectly crafted cover letter?
Honestly, I'd stopped reading cover letters years ago, and most of them are written by AI anyways.
She says figuring out if someone's a good candidate is taking longer and can cost more. New polling backs that up. Nearly 9 in 10 Canadian hiring managers are reporting a heavier workload due to candidates using AI, and 61% agree it has slowed the hiring process.
The expert advice for job hunters is to keep your resume simple and use AI only as a tool. Don't let it do everything, because in the end, in an interview, you're on your own. Andrew Johnson, CTV News, Vancouver.
Just ahead, the markets will be turning their attention to the upcoming Bank of Canada and Federal Reserve announcements. So what should investors be looking out for? We've got more on that next. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Canada's inflation rate cooled more than expected last month. Data from StatsCan shows the consumer price index slowed to 1.8% in February, which is lower than what many analysts expected. Food and shelter prices also slowed, while gasoline prices fell more than 14%. The main driver, though, of the slowdown in inflation was the ending of the temporary sales tax break. BCE, CoreWeave, and Cerebras Systems will collaborate on one of Canada's most powerful data centers in Saskatchewan. The 300-megawatt facility will be dedicated to AI computing, and the first phase is expected to come online in the first half of next year. BCE plans to invest $1.7 billion to build the facility's 4 data center halls, and says the project has the potential to generate economic value of about $12 billion. BCE is, of course, the parent company of BNN Bloomberg through its Bell Media division. And shares of Meta Platforms are getting a boost today. The tech giant has signed a major AI infrastructure agreement worth up to $27 billion US with cloud provider Nebius Group. Nebius will provide $12 billion in dedicated computing capacity, with Meta committing to purchase as much as $15 billion more as additional infrastructure is built. There's also reports the social media giant is planning layoffs, which could affect 20% or more of the company. And we'll take a quick look at the TSX this morning, trading up by 0.8% to start the morning after a slow week last week. It seems as though investors are a little more optimistic today. We're also seeing a brief slide in the price of oil, which could be impacting things. If we take a look at the U.S. markets, it's a similar story to start your Monday morning. I believe most of them are trading up at the moment. There they are. Yeah, all up by more than a percentage point. S&P 500, Dow Jones, and the NASDAQ. Iran is denying President Donald Trump's claims that a ceasefire talks are underway, even as new attacks emerge off the Persian Gulf. Markets are now shifting focus to this week's Federal Reserve decision and how policymakers plan to navigate the economic impact of the oil shock. So joining us now is Cole Ketcher, Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. It's good to have you join us. Good morning.
Good morning. Thanks for having me on.
So we're seeing a bit of a rebound in the stock market this morning. Oil prices sliding ever so slightly. Do you expect that to continue, or is this just some of the volatility we're expecting to see now?
Yeah, I think that this is just volatility. I mean, last week, a number of indexes had bad weeks. This week it might be a little bit different. I think until, there's a little bit more clarity on a number of things, including, the conflict or war in the Middle East, some of the stuff going on inside the Fed Reserve, and, just with the Trump kind of government, there's just no easy days. So there's always something in the news cycle that adds to the volatility. So I think that that's just kind of the world we're going to live in here. And until we get something that really, drives the market forward, whether that be, the ending of this conflict or a clear path to interest rate decreases, I think that we're just going to be, one step forward, one step back, and hopefully we grind higher. But, the start of the year has been really much ado about nothing so far.
Yeah, it's been an interesting year so far, that's for sure. Gold has been falling over the last couple of weeks. I'm wondering, what's the correlation between gold and oil? How do they typically interact? Are you surprised to see gold falling?
Well, I mean, if you believe that gold should be a safe haven asset, then you would think that they would actually perk up right now. But I think what we've seen is a lot of these correlations that at one time maybe seemed to exist, whether it's between stocks and bonds or, bonds and gold or gold in the equity market or gold and oil, they're not really sticking to, what they would have done traditionally. So I think in the instance of gold, it's been more so that it's just traded up so significantly over the last year, so that anything that spikes that much, it can have a pullback really at any time. And so whether that pullback is, in the short or medium term, I guess depends on your view on what gold's going to do going forward. But, given everything going on in the world, you would think that it would lead to actual gold price climbing, but that hasn't really happened. So there seems to be a little bit of a divide into some of these things that would naturally be tied together.
Are you still holding gold within your portfolio right now? Do you think that's a good place for investors to be?
I'm not a big gold bug, so I know people on this show, and there's a lot of investors out there who have been more involved in the gold trade. So while I would love to say that I bought it low and sold it high, and I would just be not being honest. So unfortunately, with the gold trade, it's just not something where I typically would have it inside my portfolios. But I do know, within Wellington Altus, that there's a number of people advisors who have owned gold and have done very well with it. So every advisor or every, person who manages money will have their own take on things. And for me, I've just generally stayed out of the gold investment realm. But I think as it relates to a well-diversified portfolio, there's really no reason that you can own gold. For ourselves, we, use other alternatives and different investments to kind of take the place of that. But, if you're going to own it, you own it during the good, and, that's why you rebalance. You want to trim when things are higher, and hopefully if there is a pullback, then you're a little bit underexposed to it.
Okay, let's talk about the rate decisions that are coming up this week from both the Bank of Canada and the Federal Reserve happening on Wednesday. Are there any key signals, like wording or themes you're watching for before these announcements? And what are you kind of advising investors to do ahead of something like this?
Yeah, so I think specifically in the U.S. right now, it's very tough, frankly, with Powell most likely being on the way out, but then, Kevin Warsh not necessarily being ready to be sworn in yet. It's a really questionable time in, what's going to happen within interest rates. And I think right now, the market has really started to price in that there are going to be a lot fewer cuts than maybe were hoped earlier in the year. And, that could change quickly. It seems like jobs data is really starting to decrease. But then on the other side, inflation is, with the price of oil is really starting to bump up again. So it's a really tricky spot, specifically within the U.S. market. And then, here in Canada, I think that, the bulk of rate cuts have probably happened over the last year. I would expect a hold for the time being, just again with the potential price spike coming from gas and oil prices. And so generally when there's a shock event, these policymakers like to take a little bit of time to see what the impact is going to be on purchasing and consumer spending, and then they'll adjust from there. So with this war having just started, a few weeks ago, I think it's probably too early to act decisively one way or another. So I am interested in the language that is going to, accompany the actual rate decision. But I would expect that for now, they're going to kind of be along the areas of we're taking a wait and see, while this, conflict plays out, and further decisions will be made at the next meeting, which maybe is until June. So.
Okay. Just before we wrap up here, I did want to get your thoughts on another story we're following closely today. That's Meta. The stock price up today by more than 2%. Obviously, they've signed a major infrastructure agreement, but there's also reports that they're planning to lay off at least 20% of the company's staff. So I wanted to get your thoughts on exactly what's going on with Meta, what you're seeing, and how those layoffs could maybe affect the company.
Well, I think a lot of these companies, whether it be Meta or Amazon, I think Block, they're starting to realize that with their AI spend, they need to fund it from somewhere. And so a lot of that funding seems to be coming from tightening up on, the hiring or, releasing employees who had worked with these companies. So, these companies need to be cognizant of the spend. Obviously, with a lot of the earnings from these companies, the earnings were great, but where the market kind of got scared off was the amount of money that they're going to be spending on data centers and the AI build out. And some of that spending needs to be, reined in from other places. And so whether it's AI is making, these companies more efficient and they don't need these workers anymore, or it's just a simple cost-cutting measure, that's probably dependent upon each company. But, it's a little bit worrisome in that what's good for the stock market or a specific stock is sometimes not good for the rest of the economy, as, those are high paying jobs which are likely being lost, and, that hurts. So I think that, we'll continue to see this. And I know that with some of the job weakness already, it is something that most likely we're going to continue to see really for the next number of years. And I think that's a big worry of some of the economists out there, as it should be.
For sure. Okay, Cole Ketcher, we will leave it there. Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. Appreciate you joining us. Thanks so much.
Thanks for having me.
Coming up, we are talking to Tony Marino, CEO of Tenaz Energy, on its latest earnings report and what is next for the company. Stay with us. That's right after the break. Canadian company Tenaz Energy released its latest quarter earnings report. Production and cash flow surged following major acquisitions in the Dutch North Sea. So for more, we're going to bring in Tony Marino, CEO of Tenaz Energy, on what's ahead for the company, joining us in studio today. Welcome. Thanks for joining us.
Thank you, Lindsay. Pleasure to be here.
So Tenaz has become the largest natural gas producer in the Dutch North Sea. I'm wondering now, knowing that, how important is the European market compared to the North American market when it comes to long-term growth?
It's by far the most important one for us. Minor part of the company, we do have a Canadian asset, and it's a good one. Today, it's about 10% of the production base. It grows too, but it's going to grow at a slower pace than our European operation in Netherlands. So, Netherlands with this TTF gas, the European gas, is going to become a bigger and bigger part of the company over time, because we should have some very strong growth going forward in Netherlands.
Why is that? What's driving some of that growth, particularly in the Netherlands?
Yeah, well, the acquisitions that we closed last year, two major ones, one operated, buying from Shell and Exxon, and another non-operated deal buying from private equity, both have very significant growth, we think, going forward. The one that we got from the majors, from Shell and Exxon, was a kind of midlife asset, but it had very little development activity for a long period of time. So there's a lot of good opportunities there. For example, we just drilled what we think is quite a good well that we announced with this quarter, just tested over the last couple of weeks. The other asset is a very early stage development project offshore on the Netherlands-German maritime border, and it's just in the early stages of production. A lot of, we think, good locations to drill, numerous pools to develop, and a lot of facility capacity. So that one will grow very rapidly too. You put together these two quite rapidly growing asset bases, and we should have very, very strong growth in the country.
And Tenaz reported production increased more than 250% for 2025. That's a lot of growth in a short amount of time, right? So is it some of those acquisitions that you mentioned that is fueling that growth, or what else?
It's exactly that, first and foremost, because we only count the production after we close the acquisitions. One closed in May, one closed in October, so there's kind of this big gush of reported production that come out of those. But within each of them, then, we have this organic growth component that we think will be, more or less steady, long period of growth, multiple years for sure, out of each of them. That contributed some to last year's growth, and unless we have another transaction, it'll be the source of all the growth this year. I mean, this year, again, we're going to grow midpoint range to 21,000 BOED, up maybe 5,000 BOED from where we closed the year in 25, and then of course during the year there's growth, so the exit rate would be substantially higher even than that 21,000 BOED midpoint. So we'll get organic growth this year, always a potential for other transactions. We can't really know one way or the other if they'll actually occur, but the really important message is that we have organic growth built in, and actually at quite a high rate.
I wonder, everything that's happening in the Middle East right now, if that's, watching the price of oil surge, is that a concern for you at this time? Like, what are you really watching for in terms of the geopolitical tensions that might be affecting your sector?
Yeah, certainly it's a pretty crazy time, unsettling time. For us, it does lead to higher product prices and revenues because 90% of our product mix, and more than that on a percentage of revenue basis, is this Netherlands gas. It's called TTF gas. That's the index there. And prices for that have certainly surged. I mean, they're up 75% since the war started. And it's starting to have an impact down the curve, too, giving us a hedging opportunity at better prices down the curve now also. So the short to medium term revenue impact on the company is significant, and it does lead to higher revenues and higher cash flows.
Any other headwinds you're kind of watching for that you want to alert investors to, maybe?
Well, I mean, we continually try to do the best we can. These are complicated wells that we're drilling. We actually operate one rig, and we have two other non-operated rigs in the Dutch North Sea right now, and each of them is a complicated operation. For us, it's gone well to date. We were really happy with the way the first well came down. Complicated well, drilled quite well, and we had a good test out of it. 23 million cubic feet a day. So far it's been very good. It's a diversified set of opportunities. So we think that we'll do well with that organic growth over time. Pricing is always uncertain. Currently it's up. We do try to lock in a lot of that going forward. We're about half hedged so far for this year, and we'll continue to chip away at that hedging program as we have these stronger prices and hopefully stronger prices moving down the curve too.
I want to talk about spending. So for 2026, capital program expected to be $250 to $275 million. What are some of your priorities for that spending? I know you mentioned maybe some other transactions coming up.
Yeah, this level of capital we're talking about here, 250 to 275 million Canadian, is all organic. It will go for drilling, our operated rig, which we're going to run throughout the year, and these two non-op rigs currently drilling on licenses where we have an interest. There will be a workover program using a barge. Workovers are highly economic. They're not as expensive as drilling a new well, and they can yield pretty good results. So those two items are the bulk of our activity. We have about a 10 million Canadian program going as well. We'll probably have 10% or so growth in Canada out of that program, but it's only 4% of the budget. So really, that 250 to 275 is all organic activities for drilling and workovers in Netherlands primarily. Any acquisitions that we might make would be above and beyond that.
Okay, that's what I wanted to ask, right? We talked about the two big acquisitions this year that kind of helped fuel a lot of that growth. Is there any other acquisitions kind of on the horizon that you want to mention or that you can mention yet?
Well, we always maintain a very good transaction pipeline in the company. So there are a number of opportunities. There's nothing immediately coming to fruition. We can't be certain about whether any of them will occur. For us, they're really an upside today. We built the company out of this M&A activity, but it was designed to put in place this organic growth that we have going right now. If we make acquisitions, it'll be above and beyond that. We'll always attempt, You know, the current market with that huge run-up in price, it sometimes can lead to a little less active acquisition market. Sellers want more than they did before. We don't typically want to pay based on that increase. So there's no guarantee that we will make them. We like what's in there. But whether we make those acquisitions or not, we should have very, very strong growth out of these organic drilling workover projects that we have going in the company.
Okay, we'll leave it there. Appreciate you coming in studio. Thanks so much.
Thanks so much.
That is Anthony Marino, CEO of Tenaz Energy. Well, coming up, a Pakistani oil tanker is passing through one of the world's most volatile shipping lanes, the Strait of Hormuz. We've got markets are paying close attention to that. We've got more coming up right after the break. Stay with us. A first-of-its-kind poultry research barn could soon make its home in Saskatoon after a major funding boost from the Canadian Foundation for Innovation. Along with a new barn comes the ability for new research. CTV's Alison Bamford takes a look inside the project.
Come on in. There was a time when Karen Schwain-Lardner was terrified of birds.
I wouldn't touch them in my poultry production class.
But now,
I do love chickens, yes. This is the turkey tattoo. The chicken is to come.
It's a passion for the poultry researcher who's waiting for the day when this old barn where she works is replaced with a new state-of-the-art facility.
Here will be another 3,000 birds, 300 per room.
The nearly $16 million facility at the University of Saskatchewan would house about 6,000 chickens in enriched, free-run and free-range living areas and offer a biosecure viewing space for the public.
This is a one-of-a-kind research facility.
The project comes as these researchers must meet a 2036 deadline that will ban the conventional cages the hens live in now.
10 years ago, the industry made a commitment to move away from conventional housing systems like you saw today, to move to enriched, to free run, to free range. And as we do that, we need more research.
Research related to animal welfare, nutrition, even the way light impacts the birds. It will all be done at the new facility with scientists from across North America. Research that down the road could even cut the costs of eggs at the grocery store.
We take our research to the people who can use it, and we take our research ideas from the people that need it.
Due to the ever-present risk of avian influenza and other diseases, every person who steps foot in this facility must be fully gowned like this. It's the same reason these hens won't be transferred into the new barn that's expected to be built in the next 2 to 3 years.
We would never take a bird from another facility into a new facility. It'll come from a very biosecure hatchery.
A fresh start that might just convince Schwain-Lardner to hold off on her retirement. Alison Bamford, CTV News, Saskatoon.
A tanker laden with crude oil has cleared the Strait of Hormuz and is sailing to Pakistan. That's according to ship tracking data, making it the latest in just a trickle of vessels that have left the Persian Gulf since U.S. and Israeli strikes on Iran began. For more, we're joined now by Bloomberg's Alex Longley, who covers oil and shipping markets. So, Alex, I guess to start off, tell us about this tanker the oil is carrying, just how significant this is.
Yeah, so this is one of just a handful of ships that have made it out of the Persian Gulf since the war began just over 2 weeks ago. What's probably more interesting is the fact that the number of these is starting to increase slightly over the last couple of days. But for global markets, what matters is just how many ships can get through. And at the moment, it's barely any. These tankers are 1 or 2 a day, even less than that, really. And global oil markets are used to seeing dozens going through every day.
It's interesting. I mean, obviously, we've been hearing over the first couple of weeks of this that the Strait of Hormuz was closed. Obviously, it's just being very carefully controlled at this point. So I wonder, what does this tell you about shipping conditions moving forward? Could we maybe start to see more coming through?
I think it's really going to depend. The ones we're seeing more recently are tankers that are, and not just oil tankers, also gas tankers that are destined for nearby countries, particularly India and Pakistan. And there are clearly kind of back channel negotiations that are going on there to allow ships to travel through. Whether we see a kind of more wholesale movement through is really going to require a much safer situation in the region. And that doesn't look like something that's on the horizon right now. We heard President Trump over the weekend kind of rallying allies to try and get the idea of naval escorts together. But what we're seeing from ship owners is a real reticence to sail through Hormuz because of the risks, not just to the vessels or to the environmental risks in the region, but to the lives of the crew members who are on board as well. And that is going to be a major obstacle to getting traffic back to normal in the region.
So you mentioned for the most part right now, it's India and Pakistan that are having some of these ships move through because of what you say is probably back channel conversations, negotiations. Is that the way most countries need to do it right now to maybe get more tankers moving through and delivering to other countries?
I think it remains to be seen. Clearly, sort of certain countries are more in need than others. India, for example, relies on a lot of energy flows from the Persian Gulf just by virtue of the geography. It's a very short sail in normal times from countries inside the Persian Gulf to the shores of India or Pakistan. For example, here in Europe, we're maybe slightly less reliant than countries in Asia. So in order to get those flows moving, part of the issue is going to be how much do countries need it, and also how much are they able to afford to buy supplies outside the Persian Gulf, which have already kind of rallied in price since the war began.
It's such an interesting avenue, the Strait of Hormuz, right? Because so much oil usually flows through that, as you mentioned. Is there any alternatives in terms of routes?
There are some. There's probably two things to keep in mind. There are some alternatives, but they're not like for like, and they don't fully replace the volume that we see. Saudi Arabia, for example, has been ramping up its east-west pipeline. We heard from the boss of Saudi Aramco last week that the hope was that would be up to full capacity within a few days. The company estimates that would enable it to export about 5 million barrels a day at an absolute push. That's a real ceiling. And that is still far less than the kingdom would normally export through the Persian Gulf. So it gives you a sense that even kind of the biggest workarounds aren't sufficient for replacing the sheer volume of oil and gas and other products that we're losing through the Persian Gulf at the moment.
So interesting. Okay, that's Bloomberg's Alex Longley joining us live. Alex, appreciate that. Thanks so much.
Thank you.
Coming up, we will bring you the latest headlines and update you on the market. Stay with us. Stats Canada says the annual rate of inflation dipped below 2% in February as the end of last year's federal tax holiday helped take some steam out of the yearly price comparisons. Inflation last month came in at 1.8% year over year. Economists were expecting a slowdown of 1.9%. It's believed this data will likely keep the Bank of Canada on its path to hold interest rates at this week's meeting as it waits for a clearer picture. And Canada is considering joining the Joint Expeditionary Force. That's a UK-led multinational rapid response military group as it looks to deepen security partnerships. Defense Minister David McGuinty says the country is assessing potential membership, but is currently focused on rebuilding the Canadian Armed Forces. Now, the review comes as Prime Minister Mark Carney meets with Keir Starmer in London today. And shares of Dollar Tree are trading higher. That's after the discount retailer beat expectations for profit and same-store sales in its latest quarter. On the downside, the company gave an outlook for full-year sales that missed estimates. Dollar Tree says the cautious outlook is due to continued tariff uncertainty and the potential for higher freight costs tied to the war in the Middle East. We'll take a look at North American markets this morning. Stocks are rising today as we see oil dip ever so slightly. The TSX is up by 0.9% at the moment, so up almost a full percentage point. And we're seeing something similar south of the border. The S&P 500 is up by more than a full percentage point, and the NASDAQ composite up by 1.3% at the moment. Gulf economies in the Middle East could face their worst slump since the early 1990s if the Iran war drags on, with some forecasts warning of sharp contractions which could disrupt the Strait of Hormuz if the Strait of Hormuz persists. Now, despite the broader economic risks, ratings agencies say the region's banking systems remain relatively resilient for now. And earlier, we got some perspective in an interview with Redmond Ramsdale, head of Middle East bank ratings at Fitch Ratings. He began with how the region's banks came into this crisis. Have a listen.
coming into this conflict, the Gulf banking systems were in a very strong position, very strong non-oil growth, very strong loan growth, capital, profitability, very strong positions. Again, asset quality, probably the best we've seen in a very long time. So coming into the conflict, very much in a position of strength.
What are the main avenues of risk to the banks the longer the war persists? What are you watching out for?
Yeah, no, very good question. I mean, look, our base case is still predicated on a relatively short regional conflict. And under that scenario, the banks face few immediate credit risks. The starting point for us at least is out of the nearly 60 GCC banks that we rate, over 85% of those are driven by sovereign support. And we believe that GCC sovereigns generally have sufficient headroom to withstand a short regional conflict. But, you know, we've got to see whether anything, you know, escalates significantly. Certainly, a short regional conflict, the headroom is there. And for instance, Qatar was affirmed on Friday at AA stable.
Can I just ask you to define what you mean by short? I mean, it's been going on for 2 weeks now. If all in all, let's say the war ends in a month, so another 2 weeks, does that fit your time frame?
Our time frame, our base case was based on about 4 weeks to start, and obviously, as you said, we're now a couple in. It looks at lots of different things, you know, escalation, particular sort of damage to major infrastructure and things like that we've seen, you know, that we haven't seen so far. I mean, for banks, you know, we need to sort of drill in more into sort of their standalone creditworthiness to see how they're positioned. And you kind of mentioned it at the beginning that we're coming into this with sort of, you know, sound financial metrics. I saw you put one of the charts up. I mean, capital buffers for those four major markets range from 13 to 15.5. So again, very strong position that gives pretty good buffers.
Yeah. And when you talk about future operating conditions, what do you think is going to be more impactful to the trajectory of GCC banks? The extent of oil growth or non-oil growth, as we've been covering extensively over the last few years while these economies continue with their transformation plans?
Yeah, I mean, for us, what's really driving the Gulf banking systems is kind of the non-oil growth. That is what is really driving what we've seen as really strong loan growth over the last few years. So that is kind of the key to watch here, is what's going to happen to the non-oil growth. The other key sort of what to watch really is confidence in the region. I mean, it's been very, very strong, but, you know, that can really change the trajectory if you start to see sort of expats, you know, leaving, or, you know, less resilience in terms of the retail market or in the real estate market. But going back to your question, it's kind of non-oil growth. What we're expecting now is lower loan growth, and obviously financial metrics of the banks will be slightly down. But again, that's still predicated on our relatively short-term base case.
Yeah, and one other question, still early days to your point. It's difficult to assess, but one of the booming sectors, especially here in Dubai, has been real estate. And I wonder whether at some point the market is going to have to account for a potential slowdown in real estate. I'm not saying that it's happening right now, but the longer this war persists, then you'll likely get knock-on effects there and potentially asset quality downgrades to follow as well.
Yeah, I would agree with you if this does become sort of a longer-term thing. As I mentioned, we're going into this crisis, this conflict with asset quality for the banks, in a very strong position. We've got asset quality ratios, so I'm talking about non-performing loan ratios of sort of between 1.5% and 3.5%. We've got coverage for the whole region over 100% and all the way up to 250% for Kuwait. So again, we are in a very strong position, and the buffers are really quite good to be able to withstand deterioration. But you're right, real estate is probably one of the key areas that could see some deterioration. And again, as you said, particularly, Dubai, UAE in general. Again, we're too, we're not close enough yet to know that. I mean, we've been predicting a real estate correction. That's still on the cards. And the correction that we're predicting was still absolutely manageable for the banks.
Coming up, Hot Picks, we will zero in on 3 plays in the biotech sector right after this. Stay with us. Welcome back. It is time now for Hot Picks, and today we are zeroing in on 3 plays in the biotech sector. Our next guest has Sionna Therapeutics as her top pick, and she points to meaningful upside as Sionna delivers positive data from its ongoing cystic fibrosis drug trials. So let's get more perspective now from Ritu Baral, Managing Director covering healthcare and biotechnology at TD Cowen. It's good to have you join us.
Good morning.
Good morning. So let's start. Sionna Therapeutics, let's talk about these drug trials. What are you watching for here?
We're watching for phase 2b data. Sionna has a completely new drug class of CF drugs. Now, the 500-pound gorilla in the space has always been Vertex Pharmaceuticals, one of the enduring legacy large caps in biotech. And that has pioneered a class of drugs that has become standard of care. Now, Sionna, almost like a David and Goliath, has come in with a very new, possibly complementary, but different class of drugs that goes to the heart of the mutation that most CF patients have, that actually has the potential to boost the performance of standard of care or do better on its own. We're waiting for phase 2 data on a key biomarker around mid-year that could tell us whether this drug could be very life-changing for so many of the cystic fibrosis patients, that about 2/3 of which actually do not get to normal function, normal CF function, CF channel function, which is the root mutation, on standard of care right now. We think that represents probably 100% upside, maybe even more. This is one of your classic binary biotech stocks.
Wow. Okay. So obviously a market there for that. So you think, you said mid-year, you're waiting to see the next phase of Sionna Therapeutics around mid-year. It sounds as though you're pretty optimistic.
I am very optimistic. The science supports it. The clinical trial conduct has been positive. It's an excellent management team. All those things together usually result in predictable alpha.
Let's go to your second hot pick now. It is Praxis Precision Medicines. Why do you like this one?
This one is and will be entering a product cycle. Now, product cycles are so important for emerging large cap biotechs. Praxis not long ago was a small cap. They had excellent phase 3 binary data. Now that binary clinical data risk is behind us. You can see it right there on the chart. No surprise where that data hit. And now we're looking at an approval story and a drug launch story, likely in early 2027. So this is de-risked from a science perspective. Now, this is much more a commercial perspective. Their lead drug will be Ulixa for a new indication called essential tremor. It's something that affects 2 million plus patients in North America, and it is a completely untapped market. There are no approved branded therapies that target it, and certainly target it to a degree that makes a significant difference in patients' lives. So this is the potential, Greenfield's potential for a $1 billion+ market opportunity, and we model about $6 billion in peak potential sales for Praxis.
Wow. You were saying you spoke with the CEO recently on navigating the FDA in these unprecedented times. I'm sure that goes for all three of your picks today. Like, what are you talking about when you're talking about these unprecedented times?
Well, the FDA has had staffing issues. The division itself and HHS has had significant leadership turnover, significant staffing turnover. There's certainly an investor focus on timelines being met and on predictability of regulatory outcomes based on what has been publicly disclosed about the clinical data. We've had a number of surprises, and we've had a number of instances where what was communicated to management teams has not been reflective of what that ultimate outcome is. And his advice at the very end was talk early, talk often, establish a relationship, and be patient.
Okay, let's get to your third hot pick. This is Palvella Therapeutics. What do you like about this one?
This was one of my the last time I was on here, this was my binary risk favorite. And that binary risk, as of a couple months ago, did actually work out. If you look at that stock price, you can see right there where it worked out. This is now turning into the same sort of story that Praxis was. This was an excellent data set, well above expectations. And now they're looking also at navigating the FDA. However, we think in our experience, even with this new, slightly unpredictable FDA, when you don't have a complex data set, when you have a simple data set with agreement and alignment with the agency, and you have a data set that is, again, nothing but net, we see regulatory approval as highly, highly de-risked, and therefore a likely approval that will drive further alpha, further upside, and then Palvella will be entering its own product cycle post-approval with a deep, deep pipeline of a platform science behind it.
And Palvella also saying today it was granted a European patent for its skin disease treatment. I'm not sure if that's the same gel that you were just referencing, but I mean, how significant is that to have a European patent at least?
A European patent would open up rest of world sales. There's a lot of companies that reference European patents in their own patent portfolio in rest of world geographies, rest of world market opportunities. We think that in rare diseases, oftentimes rest of world represents 50% or equal portions of what North America, including the US, could represent for these sort of rare genetic conditions, which is Palvella's sweet spot.
So interesting. Okay, we will leave it there. Ritu, thanks so much for your time. Appreciate it.
Thank you.
That is Ritu Baral, Managing Director covering healthcare and biotechnology at TD Cowen. Well, coming up, the crisis in the Middle East continues to push gas prices higher here in Canada, and it's giving electric vehicle advocates some fresh ammunition. We've got more on that right after this. The crisis in the Middle East continues to push the price of gas up in Canada, and it's also prompting EV advocates to talk up the benefits of diminishing our reliance on oil. CTV's Quebec Bureau Chief Geneviève Bogeman has more in this report.
Those in EVs bypassing the gas station avoid this sticker shock. A litre is now hovering around $1.88 in Montreal.
I've been aware of the price of gas. I haven't been watching it. Because I don't have to.
And how does that feel right now?
Pretty good.
The electrification industry says the latest oil crisis serves as a reminder that volatility is part of the gas game. Not so for cheaper power. And Electric Mobility Canada says those looking to buy Canadian should consider what they put in the tank.
More than 70% of the oil sands are owned by foreign companies. And the vast majority of electricity production is owned by Canadian utilities.
But that may not seal the deal for many car buyers. After all, critics say the high price of oil is cascading throughout the economy, where EVs are still a pricey bet.
Even if you drive an electric vehicle, it's going to impact the cost of pretty much everything, including the building of those EVs.
That has some pushing other solutions that have nothing to do with EVs, including government-issued rebates to make up for higher gas prices. This as the latest Statistics Canada numbers show new zero-emission vehicle sales slowed 36% from December 2024 to December 2025. EV advocates, though, say they see early signs of a reversal in that trend.
The future of the auto industry.
A February announcement of a return to federal EV rebates could be giving the industry a boost, say advocates. To Gilbert Bouc, no pain at the pump is an added benefit.
At one point, I was not sure, is it really worth it or not? But for the price of the gas now, I guess it's worth it.
Now, it's not clear just how long this volatility will last and whether indeed it will be part of the decision-making when it comes to EV purchasing. Geneviève Beauchemin, CTV News, Montreal. Well, from EVs to AI, it's no secret artificial intelligence in some ways is making lives easier. If you're working on your resume to apply for a new job, AI can help produce a finished product sure to impress. But as CTV's BC Bureau Chief Andrew Johnson reports, the number of job hunters cutting corners with AI is creating new headaches for hiring managers trying to figure out who they're really dealing with.
Eden Potier spent his teens breakdancing his way into high-level competitions. But dance doesn't always pay the bills, so he's at this employment center looking for a job in the trades.
A little bit daunting, to be fair. You go on Indeed, and there's so many different jobs you can apply for, and when you look at how many people have applied to each, it can be kind of overwhelming.
Potier knows new tech can help, but he's not sure about artificial intelligence.
I think it kind of becomes unfair for the person who tries to not use AI and wants to actually put the effort in themselves.
Many others have gone all in on a world where sweating over resumes and fighting with formatting is a thing of the past.
A lot of our clients have learning disabilities. I myself have dyslexia, so I have that unique perspective of knowing just how much it sucks.
Now AI can take care of that and your application will look great. But then what?
You can't trust the documentation you're receiving from candidates the same way anymore.
Recruitment agencies say resumes are all starting to look the same, and your perfectly crafted cover letter?
Honestly, I'd stopped reading cover letters years ago, and most of them are written by AI anyways.
She says figuring out if someone's a good candidate is taking longer and can cost more. New polling backs that up. Nearly 9 in 10 Canadian hiring managers are reporting a heavier workload due to candidates using AI, and 61% agree it has slowed the hiring process.
The expert advice for job hunters is to keep your resume simple and use AI only as a tool. Don't let it do everything, because in the end, in an interview, you're on your own. Andrew Johnson, CTV News, Vancouver.
Okay, let's take a quick look at the markets before we wrap up here. It seems as though we're going through a bit of a rebound today. You can see the TSX is up by 0.6%. Investors may be a little more hopeful in terms of what could happen in the Middle East, potentially more opening up of the Strait of Hormuz for tankers to move through. It seems as though investors feeling a little optimistic this morning. We'll keep an eye on that throughout the day, of course. If we take a look at some of the big movers and really movers on the TSX today, MDA Space is one of them, a big gainer today after it announced the closing of an IPO in the United States. And you can see MDA Space is up by 1.7% to start the day after a bit of a volatile start to the year. BCE is another company that we're watching closely today. Of course, we were speaking with the CEO earlier today. We know that BCE is building a very big data center in Western Canada, in Saskatchewan. It will be the biggest in terms of how many megawatts it has when it is built. And so we're continuing to follow that today. Also watching Nutrien as another bit of a loser today. Is down the most on the TSX at the moment. Of course, that can all change. Scotiabank says Nutrien looks overstretched amid the rally in fertilizer stocks since the conflict in Iran started. Of course, obviously the price of fertilizer has gone up ever since this conflict has started. Go Easy, another one. It's the second biggest lagger on the TSX so far today. Down again. It's down by almost 4% at the moment after losing nearly 76% last week. Today, it was one of the stocks to see considerable gains in short interest. And we'll take a look at the U.S. markets just before we wrap up here. As I mentioned, a bit of optimism today to start this Monday morning. The S&P 500 up by more than a percentage point. So is the NASDAQ. The Dow Jones almost up by a full percentage point. We're going to keep watching that today to see what investors, how they're feeling as we move into this week. Also watching for those rate decisions on Wednesday as well, which could be factoring into this. That wraps up this edition of the Open Morning Markets with Roger Peterson. Is up next. Stay tuned.